Hi, this is Tony at Cover. I'm speaking to Adrian Mincher, the director at Earnix, and we're speaking on the back of your summit that was held in September. Adrian, thank you very much for taking the time to chat to me and catch up.
You're welcome. Thank you for this. Thanks,
Uh,
Tony. Good to meet you again.
Brilliant. There were quite a few things that came out at your summit, and I'll give a bit more information about that later. But uh, a lot of when we have discussions nowadays on insurance, and we've just had a session on AI in Johannesburg, it all comes back to data because it has always been important, but it's never been the starting point. And nowadays, it seems like data is really the starting point. So I'm glad to be talking to you because I've got a bit of background now from yesterday, and one of the big things, obviously, topics is underwriting when it comes to pricing, when it comes to risk, and this was a hot topic for you. So maybe we can just start off with you just giving us a little bit of a, a high level overview of the changing face of underwriting driven by data.
Yeah, I think that's a really good question. I think traditionally, if we look at underwriting, it was very much subject matter expert. It was certainly for specialty lines and large commercial lines. It was all down to experience. But now, with personal lines, private lines, and SME commercial, they're using data a lot more. What we see the trend is that the trend of data being used, consumed, certainly with AI as well, looking at trends in claims data and exposure data, is now moving into that specialty and large commercial arena as well. And if anything, it's how do you actually utilize that data? Because a lot of insurance companies and intermediaries have got a lot of data, but I think there's a frustration and really a challenge to actually use that data and actually effectively to predict losses, look at underwriting profiles, looking at peril exposure, so on and so forth.
So, how is the integration of data analytics specifically? Because that's where almost the sweet spot lies. How's that transformed the underwriting process?
If anything, looking at taking that data, consuming it, and looking at trends across their portfolio, they can analyze the data of their book of business. They can then start to say, okay, where are our hotspots? Where is the largest loss ratio? Where we think about the increased peril exposure with floods and fire, windstorm. Having the ability to predict where those exposures are going to be more concentrated allows the insurance company, the underwriting effectively, to determine what risk profile they want to underwrite. They can be a lot more granular, whereas traditionally it was more of a generic approach.
Mm.
That's
Mm. Yeah, you started off with talking about, as you say, the traditional approach. It was very much a hands on underwriter with skill, lots of experience. How does this all now change the role of this underwriter in the insurance environment?
That's a really good question. So, if anything, what we're doing is utilizing data to support the underwriting teams, the SMEs, to actually give them a more informed kind of decision, not only when they're underwriting, but also thinking about the underwriting strategy, giving the chief underwriting officers and also the chief pricing officers a better understanding of their risk profile to give them a more informed choice on what their strategy should be.
Mm. And what are the sort of tools and technologies that they're using to do this? What is being provided to them?
I think there's quite a few insurtechs on the market now that kind of support that. But traditionally, insurance, large specialty lines and large commercial tend to work with Excel spreadsheets and maybe moving more towards native Python kind of applications. But also, the likes of what we do can support that kind of insight, strategy, impact analysis, what if scenario kind of thing. But there are quite a few tools out there. And I think if anything, there's a insurance companies have got a lot of data and there are a lot of analytical tools to slice and dice that.
Mm. So if you have those tools now and the capabilities in your business, sort of, um, how does this technology and tools enhance data-driven underwriting?
So it goes back to strategy. So having that data in place allows the profile of the insurance company to determine what risk they wanted to underwrite. And then looking at the granularity of that data allows them to really get into the detail of specifically what areas of risk do they want to undertake. It's really giving them more, as I said before, more insightful information around trends. They want to clearly improve their loss ratio. And actually, this supports that kind of whole process. It's providing an informed decision for those underwriters and the underwriting teams to determine what risk they do want to underwrite and where they want to concentrate their efforts.
Hmm. And what impact does that have on risk assessment and decision making?
So if you're going to say, for example, quite simply, the impact on that is better risk selection, better pricing for those risks, informed decisions to actually improve the loss ratio. That is the outcome of that. But prior to that, if we look at underwriting strategy, if they want to analyze their book of business, what they can do is understand, as I said before, where the hotspots are, where the highest loss ratios are, look at the peril exposure, and actually determine if they do want to underwrite those specific risks. They can become a lot more selective. But when we look at impact strategy, we can look at certain KPIs, for example, market share, the bottom line, as in the loss ratio, but also they can determine if they do want to, and again, the way that underwriting is changing is that they're now in tune with the pricing team. So analytically, working together, they can actually have that informed decision to say, what is our decision in these specific areas, these types of risk? And then they can become a lot more selective to improve that. One, they can improve their profitability, look at improved market share, and also be more competitive with their pricing, where they know their exposure to certain perils in certain specific areas is improved.
Mm-hmm. And that sort of indicates that they can be more dynamic, more flexible in how they underwrite, how the process works. What are the benefits of that?
Process efficiency, right? So we're looking at being a lot more agile, being a lot more kind of quick to market. One, they can make decisions a lot more quicker. They can actually go to market a lot more effectively. And ultimately, they can actually improve their expense ratio.
Yeah. And at the end of the day, we're talking about efficiency, which, as you say, is all about cost. And so that's what you're going for. You're going for speed within this process to get it done quickly. But you also need accuracy. You can't sacrifice the accuracy that previously maybe was slower, etc. But you had somebody there that had done this before. He's done it many times. He's got a gut feel. Now you're relying on a process. How does that get affected?
So when we look at large data sets and we look at analytics to understand if anything, the profile of those risks, traditionally, it will be a case of looking at the numbers to say, what is the loss ratio? What is the exposure? What is the aggregated exposure? But what we can do now, we're looking at propensity of claims, the value of those claims, to actually digest large data sets. Using AI, using machine learning can actually improve the performance and actually look at trends on a larger greater amount of data, a lot more effectively, a lot quicker. Now, the problem lies there is that maybe with using machine learning, there could be a question around explainability, but there are new tools in place now where actually the explainability actually shows you the trends and actually justifies those decisions that are coming out. Utilizing technology to actually improve that whole process doesn't replace the underwriter process, but it supports the underwriter decisions and the actual strategy around where their portfolio is going to expand or not.
Makes a lot of sense. Yeah. It's a fascinating subject. As I said, we had this discussion around AI in this environment. Are you finding that in terms of your discussions with insurers, etc., that the topic of combining almost this process of the underwriting and the analytics, etc., with AI, does it come up a lot? And are you confident that people are actually exploring it actively enough?
Yeah, I think the insurers across EMEA, they're all embracing AI because and machine learning. It gives them that kind of lift up as in their analysis. It provides that the supporting how they're adopting their underwriting and also their pricing strategies. Now, traditionally, if we look at private lines, personal lines, small to medium enterprise, commercial, medium commercial, it's always been around there. But as we move up into specialty, I think there's a want to do that. I think there's a challenge for some insurers who haven't got as much data as they think they need or they want. But it's certainly a growing topic of consideration. Traditional methods around risk analysis, looking at linear models has been around for a long time, but now looking at auto GLMs and then moving into machine learning with explainability, it's really being embraced because it does actually turbocharge that whole kind of decision making around the strategy.
Mm, mm. And hopefully we'll get a chance to talk about it again in the future as we evolve in that space. But I thought maybe while I've got you online, just not maybe in depth, because we're going to have another follow-up conversation with somebody from Earnix on this, but at your recent summit, you also spoke a bit about the general insurance practice, pricing practice in the UK and the rules changing, etc. Maybe you can just give us a little bit of an overview of that, and how do you think that might impact on this side of in South Africa?
That's a really good question. So price walking, as it's known globally, so effectively new business and renewal business have got to be the same. Traditionally in the UK market, they would always pitch the new business quite low, and then on renewal, the renewal premium would actually be quite high. The government put a decision in place that they were going to change that, and it took a couple of years to get to hone in on the rules. But 2 years ago now, yeah, coming up for 2 years ago, the rule was introduced. So price walking for the insurers in the UK meant that they couldn't, as I said before, actually have the new business rule rates and renewals at a different level. They've got to be the same. What's happened? So we've been working with a lot of our insurer clients over the last couple of years. The effect of that is that one, they're now looking at the insurers are now modeling on longevity, okay, rather than short term. Secondly, from a consumer's perspective, the prices have gone up absolutely across the board. Now, it's considered that the UK itself sets a lot of directives around how insurance is sold, certainly to the consumers. And we're looking at certainly recently EOPA, which is a directive within across Europe, have actually the paper that they published has alluded to the fact that price walking is something they're looking at, as well as other areas. Down if it gets fed down to other territories, I certainly believe that South Africa, they're looking at price walking. So it's all about fair pricing for the consumer. So I would consider that maybe in the medium term that the South African FCA will be looking at price walking as a consideration to protect the consumer's rights.
Mm, mm. And so it might warrant us to unpack a little bit in the future as to exactly what it all means, because there's other sort of challenges that comes out of it. And yeah, obviously one of them being,
So how do you react to that legislative change? How do you price your business? How do you price your products, fund new and renewal business, and the effect on the profitability of your book? Hence, as I said, from a consumer's perspective, the prices have gone up since the legislation has been introduced. But absolutely. And there are quite a few white papers out there on that. But the benefit we've got is we've actually lived through that whole kind of change.
that's
So we've
exactly.
got a lot of experience of that. We've got a white paper out there on that we can publish and share.
Okay. Yes, please do, because I can link it again back to this. But yeah, thank you so much, first of all, for your time. And it was very interesting to chat about this. It's great to see how efficiencies are coming in all over. And if you, as a player in the industry, if you're not part of building those efficiencies, you simply will fall behind very quickly. Maybe just for the listeners, just to mention that the feedback and the videos from your session, as I understand, is available, the summit that you had, on your website, earnix.com, and
Absolutely.
people can go and have a look there. And then lastly, I look forward to seeing you at the actuarial conference. I heard that you're going to be there. That would be great to see you there.
Yeah,
Thank you.
that'd be great. We'll see you in a couple of weeks. Thanks, Tony.
Yeah,
Pleasure.
absolutely. Thank you.